Hello, chart watchers, and welcome to Market Watchers Live with Aaron Swinlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars, follow the link to Market Watchers Live, and play back the show. Each show will be archived on our site until the next show begins, so generally for 24 hours or so. If you'd like to review an older program, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, Aaron will provide me stock symbols from your questions, and I'll use your requests in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section with a link to a very brief one-question survey. Let us know what you think of Market Watchers Live and provide us suggestions if you like for future shows. For those of you joining us for the first time today, welcome to the show. It is a Monday, Thanksgiving week. We're glad that you've decided to join us. And for our regulars, welcome back. Well, Aaron, it is a holiday week, and nothing seems to be slowing the stock market, though. I mean, we keep trying to set new all-time highs and seeing a rebound now in small caps. Russell 2000 has been doing well in the last few sessions. So all in all, things have been looking better. How are you doing?
I'm doing really well. Actually, I'm getting ready for the heat. We're getting ready here in Southern California to hit record highs over the next 4 days. So 90.
What are record highs out there this time of year?
90s. It would be like, yeah, we're going to look at mid to high 90s this week. So we'll be getting the shorts out for Thanksgiving dinner. And now I'm wishing we were frying the turkey because I wouldn't have to turn the oven on.
I'll be heading north later this week, and temperatures there will not be 90. I can promise you that. But that'll be interesting. I do want to make a couple of quick announcements though before we get going. Tomorrow, you will not want to miss tomorrow. The president of Stock Charts, Chip Anderson, will be with us for everything stock charts. So I can't think of a better person to tell you what's going on in stock charts. So make sure you are here tomorrow for that. On Wednesday, I will not be here, but Aaron Swinlin has a special guest, Mark Young, who is from wallstreetsentiment.com. So the two of them will be discussing sentiment quite a bit, I'm sure. I do want to let you know there will be no Market Watchers Live this Thursday or Friday for the Thanksgiving Day holiday, but we'll be back on Monday, next Monday. And one final announcement, Julius de Kempenaar. He is the owner and creator of the RRG charts. And everyone enjoyed Julius when he joined us last time. And he's going to be back for a return visit on Friday, December 1st. So that'll be a week from this Friday. Just want to make sure you know and update your calendar as necessary. So with that, I know we got a really busy schedule today, Aaron. So I'm going to let you take over, go through the agenda, and give us that first market update.
Absolutely. So today we're going to have market updates on the half hour. And we're going to start with a discussion on chart watchers. And of course, we'll also give you the latest economic reports and news. Monday setups today, guys. We're going to see how we did with our Monday setups last week. And honestly, I haven't checked, so it'll be interesting. And then we have some new ones for the coming week. We have an earnings spotlight with John Hopkins. He'll be coming in to give us his take on the latest charts for earnings. And then we're going to do our 10 and 10 to 1, where we take those 10 symbols that you've requested on Twitter and in the chat box. And we will add those to the list, and Tom's going to annotate them. But we're going to start with MT today. So you can go look at that chart early. I don't know if Tom will. I didn't tell him, but he might. DecisionPoint report at the end of the program. And I will plan on saving some time for our mailbag because we have had kind of a lot of questions and we haven't been able to get to them with the jam-packed shows that we've been doing. So we're going to make sure we have some time to answer a few questions in the mailbag. Before I move into that market update, I did want to let everybody know what our sentiment poll results were from Friday. We asked whether the market would close higher, lower, or mostly unchanged this week. And Tom and I had already said we were going to be bulls, and it looks like most of our viewers that took the poll, of course, said higher, with a lot of unchanged. We haven't had this many in that unchanged category. And I think the key here is looking at the fact people don't want to be bearish right now. And here is the Wall Street Sentiment Survey. This is the one that Mark Young does put out. And market timers like Tom and I get our, I turn in our sentiment results, what we think is going to happen. And this is all the market timers and what they're currently feeling. And I also noted here that we only have 15% in the neutral space. So everybody is clearly bullish, and we're now looking at a ratio, the bull bear ratio, up to almost 2 at this point. We're starting to see some very bullish readings on the Wall Street Sentiment Survey. And typically the market does follow this survey because it is such a short-term survey. And like you can see here, everybody was very bullish and the market was ready to take off, and it did. So anyway, that's what our results are currently. So now I'm going to go ahead and I will move us into our first market update. All right. And here is our candle glance. I'm going to update it and make sure we have all of the latest charts. And as you can see, markets are having a good day, like Tom alluded to at the beginning of the show, with all of the major markets pretty much moving higher. Thought it was interesting, you know, small caps are, you know, starting to make a move, but today they're not really in line with these large cap indexes, the Dow and the S&P 500, for example. They've actually calmed down in the last hour or two. Wilshire 5000, however, is climbing, just like the S&P. Treasury yields are up somewhat, 23.70. UUP gapped up and is continuing higher at this time. You can see commodities gap down, but are trying to make a little bit of a recovery. Looks a lot like oil. We can see with gap down, and we're now starting to get a move to take back some of those losses from the morning on oil. Gold is suffering, and likely because the markets are doing well and the dollar is doing well. Not a surprise to see it falling. It's now at 121.40 for GLD. Volatility index is moving much lower, and again, that means that we're looking at a lot of bullish sentiment out there. Declines are leading advances at this time. I'm going to take you quickly to our home page here. And as you can see, and when we're looking at the top 10 most active for the S&P 500, GE, AMD, Bank of America are leading. The big movers, though, in the S&P 500 right now is WIN and DLPH here, Delphi Auto. So interesting to see. And do you not notice how awesome that is? I can hover over it, and now we get a mini chart. So we can see WIN making that giant move there with that big candle. Micron, it looks like, is making a move as well with a move of over 3% right now. So with that, I'm going to end our first market update and hand it back to you, Tom, for any interesting reports and maybe a quick review of our chart watchers.
Yeah, I figure first thing we'll do is I've got one economic report, but I'll get into that in just a second. I thought maybe just go over quickly the Chart Watchers newsletter. We had a fresh one out over the weekend. I continue to strongly suggest that if you're not a Chart Watcher subscriber, that you become one today. If you go to the blogs page, so if you simply click on that blogs link, it'll bring you this page. And in the middle, on the right-hand side, you'll see Join Chart Watchers. All you have to do is type in your email address and click on that sign up button, and then you will receive those newsletters in the future. They come out first and third Saturdays on each or every month. Generally, occasionally there's a slight change, but typically it's the first and third Saturdays of the month, and it's free. I mean, let me repeat that again. It's free. So there's really no reason not to be part of that Chart Watchers newsletter. To give you an idea, and then once you can either get the newsletter and go from there to the various articles, or you can go into this drop-down menu and you can click on Chart Watchers and you can bring up the articles one at a time. You can see John Murphy talking about the high yield bond ETF, the fact that it bounced off support You could certainly see the articles there. John Hopkins, who we'll be hearing from later in this show, talking about earnings and risk-adjusted returns, which is pretty critical to a successful trader. I had an article this weekend where I was talking about some of the better seasonal stocks on the S&P 500 as we head into December. So you might find that of interest. Arthur talking, and actually we had a question about this in the Market Watchers email about how you can set up the yield curve. Well, here you go. Right here in Chart Watchers, Arthur covered that and shows you how to do that on a chart. Greg Schnell talking currencies. And then, of course, Aaron talking about sentiment and the fact that it may be bearish enough to light a candle under the market here as we go forward. Certainly seeing that already today. So great information. And what's really interesting is that John Murphy and Arthur Hill both have their own blogs. John has his market message, and they're behind the paywall. So you have to be a member to get their information. Here with Chart Watchers, it's free. So again, I don't know why anyone would not want to be a member. I think everybody who uses stock charts should be a member of the Chart Watchers or a subscriber of Chart Watchers. Again, here's the spot on the blogs page, right-hand side, put in your email address, sign up, and voila, you will be receiving those twice a month. Really keeps you up to date, on what everyone is thinking at stock charts, or a lot of us, what we're thinking, what we're looking at, and just give you some ideas maybe on what you might do with your portfolio. But anyhow, I just wanted to point that out, make sure everyone knows that it was a Chart Watchers weekend. And if you're not already a member or subscriber, definitely subscribe to that. So what's going on today? Well, today's an interesting day because October leading indicators came out at 10 a.m. this morning, and they rose 1.2%. Market was expecting 0.6%. September leading indicators were revised from minus 0.2% to a positive 0.1%. So really an exacta there for the in terms of economic reports. And the reason this is an important one, this is one that I watch pretty closely, and it's one the Fed watches pretty closely because the leading economic indicators, if you're not aware, it's a composite of 10 forward-looking indicators that includes building permits. So when you're getting a building permit, you haven't built yet. So it's one of the things that they look at to forecast future economic conditions. New factory orders is another. Unemployment claims is another. And what they do is they use all this data to report what they think the economic conditions may look like, say, 6 months out. So it's really important. And the fact that they easily beat today for October, and then also revised September from negative to positive, I think that was a pretty big double whammy there. I'm going to bring up the blog article I wrote this morning because in here I actually talked about the 10-year Treasury yield and the S&P 500. So if you scroll down to I think it was the current outlook section where I wrote about it, so I don't do another annotated chart. You can just go in here and look. But the 10-year Treasury yield obviously made a big move from early September through the middle part of October, and it has since been consolidating here in what appears to me to be a pretty tight or a tightening symmetrical triangle. And if you look at the S&P 500, the S&P 500 doesn't move directly proportional with the 10-year Treasury yield, but they do tend to move hand in hand quite a bit, especially when the yield is going up, because it means money's coming out of the bond market. And that money usually finds its way into the stock market, and then the stock market goes up. So anytime you see the yield rising, money is moving away from bonds. And many times you'll see that money go right into stocks. And there you have it, explained visually about as well as I could do here with these two, or with the 10-year Treasury yield and with the S&P 500. But here with the S&P, we've also kind of been consolidating in what looks like a little bit of a symmetrical triangle. So I'm watching pretty closely to see what the yield does, and especially given that strong sentiment report, the leading economic indicators report that came out earlier today. Now here is I clicked on the chart, which is a really nice feature here at Stock Charts, where you can click on a chart within an article and it brings it up updated. So this is as of literally to the minute what's going on with the Treasury yields. And you can see that the yield has actually moved up now. We had gap lower this morning, but now we're on the move back higher. And if I pull up a 10-minute chart on this, you will see that since 10 o'clock, since that leading economic indicator report came out, the yield has been rising. So money is rotating away from the bond market, and that is helping the S&P 500 and the Dow and U.S. stocks in general to move higher today as well. So anyway, just wanted to point out some of that. A couple of other things to note for today. There are still some pretty big earnings reports, and I think you may have noticed that some of the reports coming out in the retail space have been very strong. If I pull up the XRT, you'll see that over the last 6 months, we have not been able to get above 42 resistance. This is the retail ETF, and this is a very diversified ETF. I don't think any of the stocks in this index represent more than a couple percent. So it's very, or I said index, but I meant ETF. So this XRT is a pretty good representation of what's going on in retail. And you can see the last week and a half, we have seen volume coming in. We've seen a huge spike. I think this is the most bullish that the XRT has looked in quite some time. And what that is doing is it's really helping consumer discretionary. The XLY, easy, I mean, a really nice breakout here over a triple top. We had been consolidating for a while. And during this whole period, during the summer, if you take a look at the XLY versus the S&P 500, let me pull this up for you. This is a group that has been doing okay. I mean, we're sideways consolidating, but look on a relative basis what had been happening. But I think I could draw a line here. I'm going to actually make this into a, let's make this into a line chart quickly here. Just, I think sometimes candlesticks, when you're looking at relative charts, really kind of cloud the picture. But I think what we've got is a downtrend, a relative downtrend that has been broken back to the upside. So I think that the strength in retail, especially if we get this XRT above 42, I think that's adding to a lot of relative strength in consumer discretionary. And when you combine relative strength with a recent absolute breakout in that group, the XLY, taking out that triple top, I think that really suggests this is a group that you want to consider as we head into year end and into 2018. The retailers strengthening are really adding a lot to the XLY right now. So we'll see whether that continues. The last point I want to make is that, we had problems with the financials. I'm going to pull up the XLF. You can see higher prices, lower MACD, negative divergence. We reset the MACD, and we have tested that 50-day. And there's also, if you look at it, there's a head and shoulder top in play. So if you lose about 25.80 or so on this chart, I think that would be very bearish, especially if the volume picks up. So you want to watch that to the downside, but I think we're in a bull market. I'm not really looking for topping signals, or at least not expecting them to execute to the downside. So I think we're going to rally off of this. I think the XLF is poised for an increase. And I think if we take a look at, say, the XLI, you can see the same thing. Higher prices, lower MACD, down below the 50. We've reset easily by going down below that center line. But I think now that we've unwound, look at how overbought we were on the XLI and where we just went down to. We're in the 40s now. We actually dipped a little bit below 40. I think the XLI is poised for rotation back into that group. The XLK, these are the four aggressive areas, by the way. Consumer discretionary, which I just talked about, financials, industrials, and here are the technology stocks. On the last high, MACD looked great. Now, we have been consolidating, and it's pulling back. But I think if we break out, you want to pay attention to it. Very similar to back here where we were going down. You can see that we were going down as we sideways consolidated. But once we finally made this breakout and retest, we were off to the races. And that's kind of what I'm looking for here as well. So maybe financials, consumer discretionary, and industrials play a little catch up with the technology sector while this consolidates. But I don't see any big problems in the four aggressive sectors, and I think that's bullish for the market. So with that, let's get into the setups for this week. I'm going to let you go first, Aaron, but I do know that your pick beat mine, or at least it was as of
let's see,
half hour ago or 45 minutes
ago. I think I got the benefit of a really good day today.
Yep, but you were already doing pretty good. But yeah, today it's up 3.7%, having a really good day. But if we pull up that 10-minute chart, and then we stretch it out to a 6-day. I mean, I've got the numbers here. I think on Halo, you got an 1810.
Mm-hmm. Let me see what I had.
And right now it's at 1896.
Oh, nice.
So very, very nice gain. That's 86 cents on $18 stock. So that's close to 5%. That's a heck of a pick for a week.
Thank you.
Most of it's today, but still from last.
Still, I mean,
yeah, it works.
yeah. I wrote about it too, so I'm very thankful because anytime I, take the time to write about a particular stock, I like it to do okay. So I was glad that it's doing what it's supposed to.
It had a very good week. PNC was my pick, and I think I had written that one down at 132.45, so it was like right over in here at this point, and it's up slightly. Gain's a gain, so I'm happy with it. It's up probably about 0.6%, something like that, 0.6%. So
higher is good.
You win, but we're only as good as our latest pick, though. So now we got to do it again. But why don't you go over what you like this week and what your final pick is?
All right. It was actually a very small group. When I ran my scan, I will show everybody how to get to my scan because every Monday when I say I ran my scan, everybody, how do I get to your scan? We'll talk about that at the end, but I ran it. I actually only got about 6. I dumped 2 of the 6. So I'm down to 4. So I'm going to start first with FMBI. This isn't my pick, but I think it's a nice little setup coming together here, but it's already on that rally move. So, as far as picking for the week, I kind of like to see something that's not already on a big run. But you can see we have a PMO buy signal currently in play. We'll see if that sticks around by the end of the day. So FMBI, First Midwest Bank Corp, I think looks good. And I see this reverse head and shoulders. I did go into the weekly chart to make sure it is coming into this reversal pattern. So I'm going to show you the weekly chart. So I still think this is good, but I just didn't think as far as a, pick for the week, a really short-term investment. I didn't think it was quite right. But you can see it came down into this head and shoulders pattern. And if we get that execution, that would help us set a new all-time high. But you look at the weekly PMO, it still looks good. So I think this is a pretty decent pick, but I'm not going to, it's not short-term enough for what we do here when we pick Monday setups. But I did want to point it out for anybody who's a little longer term. Regis Corp, this was another one that looked good. I didn't actually pick it, but I think it's still a pretty strong setup. Where we just gotten a PMO buy signal currently is in play for today. Had that back to the support level that was previous resistance. And you can see it was an important level because even back here in early 2017, that level was important and managed to get back above it and it's staying there. So I think that one looks pretty good. But again, it's kind of already made this run, but it's set up nicely. It really is for maybe a longer term look. Zions Bank Corp, similar situation, similar setup here for Zion. Breakout above previous resistance, and it's making its move toward overhead resistance. Again, I think it's good, but it's already in a 1.5% move today. So again, not a super short-term pick, but I think it is lining up pretty nicely. But my pick this week is actually going to be MTH, Meritage or Meritage. I don't know how you want to pronounce it. I usually say Meritage, like the wine. But anyway, Meritage Homes. And again, we got that breakout, but look, we pulled back and we're now sitting on that support. So I like that we don't actually have the PMO buy signal. So this is something that might be more in an early move. And especially after that breakout, that's what we want to see. It looks like it's, sort of pulling back here a little bit closer to that support line, but it is still up. Really nice OBV volume following upward with this trend. You can also see the scooters in that hot zone. So in an intermediate to long-term perspective amongst its peers, it is superior. I like this one. I did want to double check the weekly chart, which I did. And here we go. You can see the significance of this current breakout. I mean, we're breaking out above highs we saw in 14 and 15, and it's maintaining at this point. Look at the PMO with this whole rise here. We were seeing the PMO bottoms rising, very nice setup. And now we've got the PMO reading higher than we've seen and since 2013. So this one I thought was a good overall pick. So I'm going with MTH right now. And I guess the last it says $50.35.
All right. It's in the books.
Okay.
All right. I like that one too. I like the home builders. They continue to do well. I was looking at the home builders last week just to see, with all the solid news that came out, whether or not we might see some kind of a topping candle, but we have not. That group continues to move to new highs. So as long as that group continues to do strong, it looks to me like MTH, which has been performing great in 2017, probably moves up with it. So I think that's a good pick.
All righty.
Let's see. So for me, let me go ahead and bring my chart up. All right. So I was looking at it on the weekly chart too. That one looked good. The other thing I wanted to mention, you mentioned that RGS. I was looking at that chart, and it had a negative divergence on the daily chart on that high in October. And see, there's the lower MACD. Now, if it breaks out and it's got big volume, I tend to ignore that negative divergence. I was actually responding to a question earlier. Someone had asked in an email. But here was a breakout. Here's your lower MACD. But look at the volume on the breakout. The volume was falling apart too. So it really is a double, excuse me, a double whammy in terms of momentum. But we went right down to that 50-day, printed a hammer right on the 50-day, reset, and then off to the races. So this is how I like to use the MACD. I like to use it as a secondary indicator in relationship to price and volume. But I thought RGS was pretty interesting as well. Just wanted to point that out.
Cool.
So, onward. My stocks that I have for this week, so I'm going to go through the setups real quick. And you can get these, by the way, if you go into the blogs, if you go into my blog at Trading Places, as soon as you pull the blog up right here, you can click on the live chart list. So we can do it this way. And you'll see all of my setups here. And not just this past week or this week, but also in the last few weeks. So you can kind of get an idea of how they've done. But ABB, I like the fact that it was coming back down, testing the 50-day, getting close to the recent lows that we've seen. So I thought 24.80 to 25 is a pretty good support level. It did start to bounce off of that today. Weight Watchers, I think after gapping up on massive volume, this was earnings related, came all the way back down, filled the gap, and put in that hammer, which I think is pretty interesting because it nearly tested this 3-month low, 3-4-month low back in September. And now it is starting to round and turn back up again. I think Weight Watchers looks good. It's just a little bit too far away from my support level, but I like the stock. AMT, this one is looking pretty good. I'd rather it be a little less volume on this pullback, but so far, holding top of gap support, holding that 20-day moving average, I think that one looks good from a reward to risk standpoint. ALV already making a bounce today, but you can see coming down and testing the support area just below 120. And then you've got prior high back in July that was cleared on the gap up in September. And so you've got some price support also coming in at around 116.5 or so. So anything under the 120 level looks pretty interesting on ALV. CXO, nice little test. You can see after the gap up here with earnings, the low that day was about 137 or so. And you can see the last few days bouncing off this level. And on the way back down, I think the volume's been lessening recently, just kind of going sideways. And my last one is GWW, which is WW Granger. That's a mouthful. But GWW, after a huge move up, very, very heavy volume, has been sideways consolidating. I'd like to get this one a little bit below 195. But I tell you what, for the pick this week, I'm going to go with it. I love this volume move on the upside. I think that the false breakout here on this long tail, I think probably set that top temporarily. We went back down one more time. I think there's probably some accumulation taking place as the stock sideways consolidates. And I think eventually we're going to go back up and test that 210 level and get a breakout. My only question is whether or not we do go back down to the top of gap support. But for purposes of this, I'm going to stick with this. It really came down for me to CXO, which I think is a little closer to support, and GWW, which happens to have a much better look in terms of volume trends with that big, big move up. You can see the volume here on CXO was decent as well, but not nearly as substantial as I saw with GWW. So I think this false breakout, I think there's some games being played, a little manipulation, but I look for the stock to go higher. So I am going to go with GWW. And if I click on this chart, the price right now is 198.29. So let's get this marked down. GWW at 198.29.
All right. So our two Monday setups then are MTH at $50. And what was it? 35?
Yep, 50.35.
Alrighty. And GWW at 198.29.
Yep, good luck.
To you too, and to the audience.
All right. Well, I know it's time for another market update. We're going to have John Hopkins with earnings beats in here in just a minute, but I'll let you take it away, Aaron.
All right. And away we go. I'm going to take us to our candle glance. I think that's always the best way to start our market updates because it gives us a nice visual on a 2-day chart what's going on. Look at the Dow and making a really nice move, rocketing higher. Does look like it might have hit its intraday high. It's starting to consolidate sideways. S&P 500 had a really nice morning, but it is starting to pull back and lose a few gains. NASDAQ is now mostly unchanged. Even, it had a nice open. Tested yesterday's close, but now it is struggling to stay above it. You can see Russell 2000 up, but then it started to consolidate even earlier than the larger cap indexes. And again, look at the Dow straight up. We can see Wilshire 5000 has pulled back on a possible double top here, which would, if executed, would bring us down. A nice review of chart patterns, everybody. Would bring us down the height of the pattern. So that would bring us probably to these lows here earlier, 26,820 if it executes on the Wilshire 5000. Treasury yields up, currently reading at 23.65. UUP had a nice gap up, consolidated, is now moving up again, forming a flag. Could see higher prices on UUP before the end of the day. Commodities are lower, gapping down, but trying to come back and reach that gap resistance at this point. For USO, 1127 is gap resistance, and we'll see if we can punch back up through that and close that gap. We've got GLD moving lower on the day, likely because we are seeing that big move by the dollar, but also we tend to see it move down on a really good day in the market. VIX is moving lower and lower, currently reading at 1053, declines leading advances. I'll bring us back to our member homepage. Let's take a quick look at the market summary to see which sectors are doing the best right now. I'm going to range it by percent change. And as we can see, we go to the sector spiders. Industrials and financials are leading as far as sector spiders. Healthcare is the big laggard today, down over 0.5% currently, with utilities not far behind, down almost 0.2%. As far as U.S. industries go, the semis, network, disk drives, lots of technology there at the top. And at the bottom, gold, not a surprise after looking at our candle glance, biotechs and natural gas, commodities, oil services, all of mostly in that commodities area, airlines likely being affected by, oil prices. So we'll have to see what happens by the end of the trading day. International ETFs, currently India and China are at the top, with India up over 1.5% currently. Laggards, Mexico and Spain, with Mexico down 0.66%. And that's all I have for our second market update. And I'll turn it back to you, see what is going on as far as earnings.
All right. I appreciate that. Yep. We are about to get into the earnings spotlight. This earnings spotlight is brought to you by earningsbeats.com. Earningsbeats.com provides a unique stock trading service that provides its members with high reward to risk trading candidates. Unlike other trading services, earningsbeats.com focuses on companies that combine both solid fundamentals and strong technical charts to best manage risk. If you're looking for a trading service that utilizes patience, trading experience, and discipline to help you navigate the stock market, go to earningsbeats.com for a trial membership. Earningsbeats.com, better timing, better trades. Mr. Hopkins, how are you doing today?
Good. How are you, Tom?
I'm good. Got a couple things. First of all, I know I'm going to be traveling north for the holidays. I'm going to be up in the Baltimore, Maryland area, kind of our old stomping grounds.
Yeah.
And I know you got family and friends in Detroit and all. Are you doing any traveling?
We're going to be, we'll be in, we were just in the Maryland area, but we'll be sticking around Charleston, having some family here. And I've been spending the last week expanding my stomach to get ready.
Uh-oh.
For the big feast.
Yeah. I don't have any problems with that one. That seems to be a daily fix for me.
Yeah. Anyways, what's that?
I was going to say, I didn't even ask Aaron, what are your plans for Thanksgiving?
Oh, well, I'm going to be going to my dad's, Carl Swenlin. If you haven't figured that out, he's my father. So we'll probably be actually talking stock market a little bit over the holiday. I always enjoy our discussions. We had to laugh, though, real quick, was I had done the sentiment for Chart Watcher. I didn't realize, but when he did his weekly wrap, he opened with the name Sentiment Chart. So he sent me this email. Hey, did you copy me, or did we just happen to? I said, no, we just happened to be on the same wavelength. So
that's I thought, Aaron, I thought you were going to just try to stay cool this week.
I know, right? With all of
it's crazy.
Well, I'll have my shorts out. Maybe we'll go swimming at my parents' house. We'll see.
Love it.
Do you live close to your dad?
Yeah, we're actually only about 35 minutes apart. So I don't see them as much as I should, admittedly. I don't know if he's listening to the program, but I do need to come out more than just on holidays. So,
yep. All right. Well, I've got a question that came in the chat room, John. I was going to go ahead and address it. And you can feel free to add anything. But the question that came in, it was right on cue, asking what are risk-adjusted returns. We talk about that a lot. And essentially, if you think about it, if you have, say, just throw out $100,000 in the S&P 500 and it's fully invested all the time, and you make $10,000, then your return is 10% over whatever time you're holding it. A risk-adjusted return, if you could somehow make $10,000 over that same time period, but do it with only, on average, 50% of your account being traded, so on average, only $50,000 is invested in the stock market, yet you still make $10,000, then your risk-adjusted return, as I calculate, would be 20%. It's $10,000 on the $50,000 that you invested, because you didn't have as much invested as everybody else in order to try to earn 10%. So that's really what you're looking at when you talk about risk-adjusted returns. It's taking into account not just your return, but how much you had to risk to get that return. And another way to look at it in a bad way is if you're in margin all the time. And so now instead of 100,000, you have 140,000 at risk, and you're still only earning that 10,000. You have to take into account not only the fact that you earn the same as someone who's investing solely in the S&P 500, but also the fact that now you've got margin costs and you had to risk a lot more money to earn that 10,000. So anyhow, just a quick little discussion.
Yeah. It's perfect timing, because in my Chart Watchers article this weekend, it was really about risk-adjusted returns and figuring out how you can actually get what I call outsized returns compared to the market. And one of the first steps, Tom, is you have to focus on high reward to risk trades and stay disciplined during the process. For example, when I talk about high reward to risk trades, I'm talking about minimum 2-to-1, and that barely registers for me when I'm looking for candidates for members. I like to look at charts that when I look at them, they present at least a 3-to-1 or higher reward to risk potential. And the way you do that is you start by looking at the best of the best. And from our perspective at Earnings Beats, that means companies that beat earnings expectations, they get a nice move to the upside, they pull back. So it's been proven, they pull back to a key support level, could be price support, could be technical support, and you get involved with them at that point, knowing that you're going to have a very tight stop. And what we did is we actually did a study. We went back over the past 6 months, and we looked at a little over 40 stocks that were trade alerts to our members. And what we found was extremely interesting. The bad news, if you want to call it bad news, the winners barely beat the losers, maybe by a couple of stocks.
You mean the number of winners?
The number of trades, okay? You barely had fewer winners than losers on the actual number of trades. But here's where it gets really interesting, Tom. What we found was that the average return on the winners was somewhere between 6 and 7%, and the average loss on the losers was just over 2%. And I went back and looked at our last 10 trades as well, in addition to the past 6 months, and it's pretty much consistent. About 6.5 to 7% on the return side of the winners, and about 2% on the losers. And by applying a risk-adjusted practice like you talked about, what you're going to find out is you're going to find out that by having those solid returns and losing, keeping your losses very low, you can get these really nice returns. And we found out that risk-adjusted return beat the S&P by almost 5 times. So in other words, if you had taken all the alerts that we put to members, and you spread it out equally, you kept your price targets and took your profits when they came in, you got out, if it hit a stop loss, that you would have beaten the S&P by almost 5 times. And that is something that, people really need to key on. And I'll give you an example real quick here. 3 stocks that we got involved in within the last, week or two. The first is General Motors, GM. That was one of our charts of the week. I talked about that once, recently on the show. And we got involved. Look at that chart, how nicely it went up, and then it pulled all the way back to the 50-day. We waited for that to happen, got involved, set our stop loss at a close below the 50-day, and set our price target for 45.10, which was just at the bottom of that gap. Right there. And we're well on the way to getting there. I think it's going to get there. And then luckily we got an upgrade today. That was just coincidental timing.
I can tell you why. I had GM and I sold it on Friday.
There you go. Okay, they got the word.
Yeah, they got the word and they upgraded it.
All right, the second one of 3 is SC, Sam Charlie. And SC we put out as an alert last week. You can see it made a beautiful move on great volume, pulled back beneath. We waited for it to recover and get back above the 20. Got involved last Friday with a price target of 1704. We hit it. We've actually adjusted the price target upwards to 1730, but you can see how key that level is right there. Tried to get through a few times. I think it's going to power through. And then the last one I want to mention is NFX. This is our chart of the week. Anybody can get.
I was just going to say that SC, you got some pretty good volume coming in today too, so breakout would be significant.
You got nice volume. And the last one is NFX. That's our chart of the week. You can get that at earningsbeats.com. There's no cost to check it out. This is one that made a great move, pulled back to the 50. I saw it this morning. Look at that nice tail. It got down to about 29.19. We put it out as an alert around 29.35 or so, with the price target back to the 200-day and a stop below that most recent tail. I think it got down to 28.87. Yep. So the whole point, Tom, behind what I'm trying to point out here is you can see that these 3 that are recent, as well as the ones we studied over that 6-month period, were all about stocks that reported great earnings, gapped up on nice solid volume, patience, wait for them to pull back, then you get involved at a close technical or price support level, you keep your stop tight, and you take your profits when they come along, and that has proven to be a winning formula.
Yeah, no doubt about it. And I know in your article you had pointed out IBM, and IBM has bounced back pretty nicely.
Yes.
I know that, but that's part of the discipline. I mean, if you say, hey, I'm going to buy in, and if it's below the 50-day you get out, then that's what you do. You just simply get out. Otherwise, the system doesn't work, because if you start making excuses, well, this one's okay because it still has this support or it has this support, that's what gets you into the big losses. And most successful traders that I've talked to over the years say the biggest mistakes they make is letting losers get bigger.
Yes.
And so if it's not doing what you think it's supposed to do, if you take a loss, and that's, that goes through your mind. You're like, well, I don't want to sell it because it might come back next week. Well, yeah, it might, and it might go down another 3 or 4% as well. Mm-hmm. So I think it's good to move back into cash and then get into something that is holding the key area that you want to hold. So, if you lose on a few here or there, but you still have those winners that you talk about where you do get those big moves to the upside, those big winners completely engulf those little small losses that you take.
You're right. And just one last thing, go back to SC for a minute. Okay. The one thing I did, which I usually don't do, but I just like the way it looks. Our target was 1704, and I sent a note out to members today saying, look, our target's 1704. I'm raising it to 1730. However, I also said you should consider taking some piece of the profit off the table because we hit our target. Okay? Because when you start changing targets, trust me, to the upside and to the downside, it almost always backfires. But in a case like this, this is such a key level for it to clear that I think it's going to do it on the volume that we're seeing. But at the same time, raise your stop. Okay, so you can raise your stop to make sure you lock in profits, take half off the table. We hit our target, but I think it's got more room to run. You got to stay disciplined. And that's, if there's one thing at Earnings Beats that we practice and preach more than anything else, it's discipline. I can't say it, enough.
And patience. I throw patience.
And patience.
Yeah.
Okay.
Good. But did you say you raised this one to 1730?
Raised it to 1730.
Why just a quarter, though? I mean, is it worth staying in if you're just going to look for 25 cents?
Well, let me tell you the way that this particular one has worked for us. A little bit different than what we normally do. I said when I put it out that the initial price target was 1705, and if it got there, we would consider raising.
Okay.
So I put it out today. So we're going to raise. I'm going to keep an eye on this thing, and if it continues to make a move, we could raise it again. And just keep raising our stops. So, the whole point is I think it's got, farther to run here. And we're going to monitor it, on a daily basis and make changes as necessary. But again, staying disciplined and, pulling those profits in when they come along. If you want to find out, by the way, the chart of the week, which today is NFX, you can go to earningsbeats.com. It's free, Tom. And a great way to get some education.
All right, let me just pull it up real quick. So earningsbeats.com and chart of the week right here.
Chart of the week right there. You can see it's NFX. And if, you just put your name in their email, you'll be able to see the actual chart with some annotations.
It's free, right?
It's free.
Okay. All right. Well, appreciate it. I know, you got the whole Thanksgiving thing coming up. Say hi to your family for me. And
you too.
Talk again soon.
All right, my friend.
All right.
Bye-bye.
There he goes. Thanks again to John Hopkins. I tell you, there are a lot of good lessons when he comes in here because risk adjusted returns and evaluating the reward to risk. I think one of the biggest mistakes made, and you probably hear this all the time as well, Aaron, when someone comes in and says, well, I think I'm going to buy this stock. And you're like, okay, well, where's your stop going to be? Well, I don't know. I'm just going to get in. It looks good. And I think that's a big mistake that a lot of traders make is that they don't consider where they believe the stock can go technically based on looking at prior price highs or maybe using measurements like you talked about last week on your chart patterns. So they don't really consider that. They don't know where they would sell. And that's just setting them up for an emotional trade because then you start losing money and you don't really know why or where you would get out. And it just gets to a point where you can't take it anymore. And you just say, okay, I'm getting out. But I do think that it's important. And I think just about everyone I know, Dr. Elder here at Stock Charts, when he's, talked about these trades, journalizing your trades and so forth. I know Gaddis Rose talks about this a lot as well, as do, many of the other authors here and commentators at Stock Charts. But that's one of the key things is knowing why you get into these stocks and what would take you out in terms of profits or in terms of stops. But anyhow, another good session with John Hopkins of earningsbeats.com. And I believe it is time
to start on time.
Yeah, let's start on time here.
One of the things we get a lot too is when we're talking about stops, are they hard stops or mental stops? And I tend to do mental stops more than hard stops, but it just depends, if I'm getting ready to go on vacation, if I'm going to, not be able to watch the market for the next day or two, and I feel like I'm close. So
your mindset, you're a little bit longer term with most of your trades though, right?
Yes, absolutely.
Yeah. For me, So I have to consider, okay, I'm going on to Market Watchers Live. Do I need to set any stops?
Right. Yeah. See,
I mean,
I'm not quite that way, but
yeah, I mean, it's for me, it's like an hour. I can't look at my stocks. Oh my gosh. But anyway, all right. So we're starting with MT, right?
Yes, we are.
All right. I really like this one, by the way. Let's take a look.
The person who gave it to us liked it too, but I think they were just looking for some confirmation.
Yeah, you had a double top from back in August and September. You can see right there. And then you've got the bottom of gap support right here. See this gap that took place on this very heavy volume? I don't know if this is earnings related or not, but notice when we came back down, this gets right back into what we were just talking about with John Hopkins. We were overbought. You really want to get out of the habit, in my opinion, of chasing stocks. I know that there are a lot of people out there, successful traders, that can buy on strength. Most of them tend to hold longer periods of time, though. I don't think it's a great strategy if you're a short-term trader. I think you're much better trying to get these trades. Or, I mean, actually, if you get in it and it quickly moves up and you take that profit, I think that's fine. But a lot of times you wait, you end up finding that a stock will pull back to support, and you could have gotten in a lot cheaper with a little bit of time and some patience. But anyway, this one, MT, came all the way back down into this support area between price support and gap support, and now is just starting to turn back to the upside. I think this one's got a good chance to get back up to that 30.5 area. And obviously, the closer you can buy it in the 27 to 27.5 area, the better in terms of reward to risk.
All right. One of the popular requests this morning was INTC. I think
I've heard of that company. Let's see, Intel. I like it on the 20-day test. This is the first one we've had in 3 months. So for me, if I was buying Intel, it would be right here, with a tight stop on a close below the 20-day. Not that it couldn't come right back up, but again, you got to figure out where your stops are. There's two key areas for me. So let's see. The first one is, I'm just going to mark it here with an arrow, but I think the first one is the 20-day moving average. Anytime that I'm seeing a move like this and the MACD going up on the most recent high to a new high, that tells me the momentum is accelerating. And I like 20-day tests when I have that kind of a setup. Now, when we go back up, if we don't break out on heavy volume, we could be dealing with a negative divergence. I'll worry about that later. But I would look for a $2 move back up to 47, and to the downside, keep a fairly tight stop. The other approach, I mean, if you're looking maybe to build a position for maybe a longer term trade or an intermediate term trade, then I would consider partial entry at the 20 and another entry if we happen to get back down to the top of gap support. There was a lot of buying when it opened at 43. So I have a feeling we're going to see strength. If we get down that low, I think we'll see some support at that area.
All right. Next one I have for you is COP.
Conoco. This is an interesting one. Negative divergence. Look at the hammer on the 50-day. I like it right here. I like these. I like that negative divergence reset. And what I'm talking about there is when you got higher prices and a lower MACD. This one definitely clearly has higher prices with a black candle on the top, by the way, which is a reversing candle. So anytime I see a negative divergence and a reversing candle, I start thinking MACD centerline reset and 50-day test. And so that it's working its way down to the center line. We're getting that 50-day test, and that's a nice little hammer. Now, it is early in the trading day. We don't know what the candle will look like later today, but if it finishes like that, especially if volume picks up a little bit, I'd like that entry, because now I could use one of two areas as a stop, either close below the 50. I could keep it really tight, or maybe the last reaction low down here at about 48.50. And if I was using 48.50, though, I wouldn't take the entire position here. I'd take half a position, and if it got down to 48.50, I'd take the second half with a close below that as a stop.
All right. Next one I have for you is for our Canadian friends, XEG.TO.
All right, another one, 50-day test, which I think is pretty interesting. I like the fact that we are continuing to put in higher highs and higher lows off of the double bottom. So I think this one looks really good. I like the RSI moving back down into the 40s, which I'll show you here in just a second. But you can kind of look at that right there. Nice little uptrend, higher highs, higher lows, continue to repeat themselves. Look at the volume on the moves to the upside, too. So I think your volume trends really look good. And these pullbacks over the past few months have represented great opportunities to get in. Notice that the last couple of lows right, let's see, right here, or that low coincided with an RSI reading down near 40. And right now we have an RSI of 43 on the selling here. And as we move down, by the way, it looks like the volume continues to drift lower as well. I would not be surprised to see the 50 hold as support. This would be another one, though, that you could build a position in, half a position at the 50 and half at the most recent low, and then keep a stop beneath that low.
Okay. Next one I have for you is LITE, which is Lumentum Holdings.
All right, LITE. Well, I'm seeing sideways consolidation, which after an uptrend, I think is bullish. If it breaks down, I would be careful and certainly would not be holding. But for now, anyway, I think that we've got a double bottom there, which is nice. And up here, we got some resistance at about 68 level, and your support is down just about 50 and a half or so. So I think that's the trading range. Right now, we're sitting almost right in the middle of it. So I don't see a trade currently, but if we moved back down, especially on lighter volume toward the lower end of this range, then I would be a much bigger fan of a long position.
Okay. Next one is DAN, Dana.
Yeah, I think this is in that auto space, and that area actually looks pretty good to me, but let's see what this one's been doing. I know it was on my strong earnings list. I think it's still on my strong earnings list. Well, here's the deal. It's breaking out. It broke out here with a negative divergence, but I'm going to show you the difference between negative divergences. I talked about one earlier today where we had light volume on the breakout. Here, as you can see, we have a negative divergence. And you say, well, why didn't this one go down to the 50-day? Well, first of all, technical analysis is not a guarantee. It doesn't matter what you're looking at and what your strategies are. I use technical analysis to manage risk, not to provide a guarantee. But here you got higher prices, lower MACD. But on this breakout, you might say it's slowing momentum, but on the breakout, look at the volume down here. This to me is not slowing momentum. I mean, this to me is accumulation. So the MACD is telling you what's taking place in terms of price. So yes, we have slowing momentum in terms of price based on a mechanical formula. But I think if you think about it and you look down here and see the increasing volume, this is not giving you signs of slowing momentum. If anything, it's telling me that this stock's under pretty serious accumulation. And the volume on the most recent move here, moving higher, has been strong as well. So I think Dana still looks very good. If it fails to make this breakout and leaves a tail up above the breakout level and comes back down, then we might be able to get a little bit lower, maybe even down to that 50-day moving average. But overall, I like this stock. It's just a matter of timing on entry.
All right. Next one I have for you is CBS. Not CVS, but CBS.
All right, CBS downtrending, but positive. Well, positive divergence, but we got a 50-day test. So let me show you here. So here what we've got is as we kept moving lower and lower throughout this move, you can see the MACD just kept getting stronger and stronger, which is good, except now we have seen a 50-day test and we have seen almost a center line test, and we've started to go back down and lost that 20-day moving average in the process. So I still don't, even though volume's coming in, I need to see a breakout. I would say a breakout above 59 might get my attention with heavy volume. But until then, I'm more concerned about this overall downtrend. Slowing price momentum, but we've kind of taken care of that now with the 50-day test. So now I just want to see what price action does. Do we hold 54 and break out above 59, or do we fail at 59 and then break down again? That's what I'd be looking for.
Okay. Next one I have is VRX, Valiant Pharmaceuticals.
Yeah, this is a popular one with traders, and a huge gap up, by the way, breaking a downtrend. So it looks better, but this has been an extremely volatile stock. So I think just make sure that you're comfortable trading a stock that's this volatile. But if so, I think that the move down here, and we probably could even make this a channel. Yeah, it's pretty close to a pretty solid looking channel there. It broke out here, and look at the volume coming in. So I find this to be bullish. Notice the top of gap support held on this last pullback. So that's the best entry down at that rising 20-day. Now we're approaching resistance. Another breakout would be bullish.
All right. Number 9, TRTN, Triton.
All right, Triton, I think, may have been on a strong earnings report as well. I can't remember if it was this one or not. Yeah, right now, I'd like to see $38 hold, and that's because that's where your price support is. We broke out above 38, and we've gone back down and tested it once, and now here we are again. Also, gap support. You can see with this gap up, heavier volume came in on the gap. We have been holding gap support and price support right around this $38 level over the past few weeks. And so that's the first key area I'd be watching for. If we have a long tail, I'd feel better if we had a longer tail to go beneath it, and then we come back up and hold it on the close. That false breakdown might give me a little bit more confidence to place this trade.
Sounds good. And now we just have one more, and we're almost exactly on time. Dick's Sporting Goods, DKS.
Yeah, well, first of all, the group, a lot of these retailers are definitely strengthening. And I think Dick's right now is at a major gap resistance level. And if it could break through, the volume trends have definitely been improving. Actually, it looks like maybe we might have gotten just above it. But look at the volume that's been coming back in. I think that this may have been more of an exhaustion move. It wasn't the final bottom here on the gap down, but that kind of volume many times will signal that, you just got a lot of the sellers out of it. And as we've been going sideways back and forth and starting to strengthen here, you can see volume trends beginning to improve. Even the one big red bar here was a hollow candle. So it gapped down, but then there were buyers. So I'm thinking DKS has bottomed, and another breakout above Friday's high, taking out this intraday, could lead to some pretty quick move to the upside, especially if this stock's got heavy short interest. You may see a lot of shorts running for cover. So I think that this one's got a pretty decent chance to make this breakout and make a move up closer to $34. To the downside, the rising 20-day moving average is what I'd watch.
Okay. Sounds good. And that's all we had for the 10 and 10.
Sweet.
All right. So I think I will go ahead and just get us into that final market update. Share the screen. That'll help. Okay, here we go. I'm going to actually make sure I have the most recent here with a refresh. And there we go. Okay, you can see most of the large cap indexes are moving higher, as the Dow is, with a nice big move higher. We're starting to see a little bit of consolidation here, moving sideways. We'll have to see if it can pop back up and make some new intraday highs. S&P 500, kind of choppy today, but we're now back close to intraday highs as well. NASDAQ is making a move with a bounce off of support there. And we can see it trying to get back up and take in some gains. We've got the Russell 2000. It was up slightly in comparison to the large cap indexes, and now has been trending lower. So we'll have to keep an eye out on those. I'm going to show you a few charts on the small caps during my DecisionPoint report. Wilshire 5000, we can see now, everybody with those chart patterns, again, this looks like a double bottom, but remember, double bottoms are reversal patterns, so you wouldn't go looking for them at the top of a rally because they're not continuation patterns. But in any case, right now, Wilshire 5000 near intraday highs. TNX, Treasury yield, or treasuries are, TNX, we're looking at 2370 right now. Currently, UUP has gapped up and is now starting to take back a little bit of those gains from earlier. Commodities down with a gap down, moving sideways. USO had the gap down, was really tumbling there. And then at lunchtime, it started to make its move back up. Could be looking at a possible flag formation there that would bring us back up toward yesterday's close. But currently, USO reading at 1123. GLD moving lower and lower right now with making intraday lows currently at 121.19. Volatility index continues to fall. We're now at 10.47. Declines are leading advances. And we'll take you very quickly here. I want to go over big scooter movers for our final update. And we could see, looking at the top 10 for large caps, usually the similar usual suspects, as they say, heading up the top 10. I'm more interested in what's moving quickly right now. RRHBY currently, and again, hovering right over that symbol. We can see that we've got that really large gap that actually closed that earlier gap from back in the late October timeframe. So interesting move right now on Roche. And LUK is the other big scooter mover as far as large caps are concerned. And we could see a pretty nice bounce there off what was the support level and continues to be really at $25. That's all I have for our final market update. And with that, was there anything you wanted to comment on before I go into my DecisionPoint report, Tom?
Yeah, I'll let you keep the screen. I just wanted to mention one historical fact that I had put in my blog earlier this morning, and that is that I was looking at the performance of the S&P 500 on the Friday after Thanksgiving. So that's this Friday, Black Friday. And it's interesting. Over the last 67 years, that Friday after Thanksgiving has been higher 49 times of the 67 years, only down 18 times. So pretty strong percentage chance that the market's going to go up higher on Friday. And the annualized return for that day, the Friday after Thanksgiving, over the last 67 years is a positive 86.83%. Now, don't misunderstand me. I'm not saying that the S&P is going to go up 86% on Friday.
Right.
This is an annualized return. So there's 67 days, and you take the total return on those 67 days, the past 67 years, which is about 23%, and you're multiplying it by 253, which is the number of trading days in the year, and dividing it by 67. So essentially, you're multiplying it by about 4, which gets you up into the 86%. But the average actual gain over the last 67 years has been roughly about 0.35%. So in today's S&P 500, that would be roughly 1/3 of 1%, or maybe 8 points, something like that. So don't get carried away, but there is that tendency for the market to move higher. Now, one other thing I'll mention is that the last 15 years, it hasn't really followed that. It's only gone up 7 times and down 8. So it's been more 50-50, but the annualized return on those 15 days is still positive, plus 16.15%. So some of you may look at it and say, well, the trend is changing. Others might look at it and say, oh, well, now it's time for things to really start to pick back up again. Those are the facts. I guess you can use them or not use them how you see fit. But it overall, over the past 67 years, the Friday after Thanksgiving has typically been pretty bullish.
All right. That's interesting. I love how you do those seasonality checks on so many different levels.
Yeah, it's a curse at the same time.
It's like Carl talks about cycles, following cycles, and pulling your hair out at the same time, because it can be difficult.
Imagine yourself Thursday sitting across from me trying to swallow your turkey while I'm telling you about the Friday after Thanksgiving and the annualized returns.
Well, actually, if Carl and I were at your Thanksgiving table, we might find that interesting, but I know others in the families might not.
I might have to join you for Thanksgiving, because I would actually enjoy that conversation.
Yeah, absolutely. I always enjoy it. Carl gives me some very good insight on a lot of things. So let's get started with our DecisionPoint report. First, I'll give you a look at the SPY. I've had questions in the past about how we come up with our signals, because I talk about the S&P 500, but I also look at the SPY when I do my DP alerts. Our signals are actually generated using the SPY. So the trend model signals and the PMO signals that I use in my DP alert are based on the SPY. However, my indicators, I know this is very confusing, is a lot of those are based on the S&P 500 numbers that come in. So I know it's confusing, but our major signals that I give to Timer Digest come from 20 and 50-day EMA crossovers on the S&P 500 SPY ETF. So that's where those signals come from. And I might as well give myself a pat on the back and let everybody know, currently, I've now moved into #1 with Timer Digest for Market Timer of the Year.
We should have horns and stuff going off. That's awesome. Great job, Aaron.
That is really a huge deal. Carl and I have never been able to hit the top of that list. So, and the reason I got there is I went on a buy signal and didn't change it since November. So it's not really, all that much as far as guesswork and in and out. Those are the people, honestly, that tend to fall down to the bottom of the list, that change their signals for the intermediate to longer term more often. So I think that's why we're doing so well. But I wanted to point out a few things. So as far as the SPY, we broke down from this rising trend channel, but I talk about a lot of times, you don't see a breakdown, you see a drift. And this was more, in my opinion, a drift through that rising bottoms trend line. So it doesn't bother me that much because we are sitting on the 20-day EMA right now. And look at what's happened since we got that PMO sell signal and top below the signal line there. We haven't really lost too much in the way of price nor support. So I think that is very interesting. I wanted to show you the Dow as well very quickly. One thing I'm noticing here, more so than on the other indexes, is a possible head and shoulders forming here. And I think you mentioned that, Tom, with a neckline right here at about 23,250 for the Dow. And we are on that sell signal, but currently we're holding that support again at that 20-day EMA. And we are entering a rather bullish part of the year. And so, even though we're seeing this possible head and shoulders, I think it gives us some insight. But even if it did execute, the height of this pattern would bring us right there, right to that support level at about 23,000. Not that we want to see that kind of a decline, but we are sort of overdue. Notice before I switch to the NASDAQ chart, notice the PMO on the Dow. And you'll see this on the S&P 500 as well as the OEX. But the NASDAQ has a very different looking PMO right now. And here you go. We hadn't gotten to that sell signal, but now it looks like it could come through either today or tomorrow. I will give you a DP bulletin if it happens today. Tomorrow, I'll probably be writing my DP alert. So I'll give you even more information if we do get that downside crossover. But I will give you a bulletin if that does happen at the end of the day. So I just thought that was very interesting. It took some time for the NASDAQ to start showing some deterioration. And really, when you look at the current setup here, we got a nice little breakout here right off that 20-day EMA. So, I think that bodes well for the rest of the market. I think what was really interesting that I want to show you are mid caps and small caps right now. We saw a really nice move and off support, as we can see here with the S&P 400 ETF IJH. And we're now starting to bang on the ceiling here of the resistance level for IJH. But notice that the PMO is now turning up. It is bottoming. And so I find that to be some interesting information as far as what we might see here with a possible breakout based on that change in momentum. IJR, which is the S&P 600 small cap ETF, as you can see, we had a really difficult decline, but very quickly over the last week, we've been making a move. And again, we're starting to hit that area of overhead resistance. IJH has hit it. IJR has not quite reached it. So I think there's still some more rally to be had there for IJR and small caps. Also notice that PMO is turned up on the small caps as well. We're not seeing that on the larger cap indexes. So I think that's positive for the market in general. You always like to see the small caps doing well. I know I've heard some comments about, well, if the tax reform doesn't pass, we're not going to, all of this rally is going to disappear. I don't know. I don't get into that politics that much. Definitely steer clear of that. So I don't know, whatever you want to think about that. What I'm looking at are the technicals. And currently we have a PMO bottom here on IWM, the Russell 2000 ETF. Look at that move of the scooter among peers. That tells me that the Russell 2000 is doing better. It's starting to improve. I'm not real thrilled with the on-balance volume, but when I look at the last, today included the volume on this move up, I think that's very positive. But we've still got some overhead resistance. It's still got to move a bit higher. So I'll be watching to see if these small caps can get up to that overhead resistance over the next few weeks. Now I'm going to take you to our indicator suite. These are our climactic indicators. They're very short-term in nature. I'm looking at net advanced declines and advanced decline volume. I look for these pops, these climactic readings on these particular indicators. New highs, same deal. And what I noticed, this is from, of course, these indicators are as of Friday. They don't, we don't get the actual numbers until, of course, the close. So looking at what we had earlier, and last week, I know I pointed this out, but we had the VIX traveled a lot higher than we have seen in a while. And notice those Bollinger Bands are starting to expand again, which makes me happy because I find the signals I take from these to be lots better when the Bollinger Bands are further apart. So right now, the VIX is really right around the average here for these Bollinger Bands and moving higher. But what I look for are these penetrations to the downside or upside. Remember, my scale is inverted because I think of the high VIX readings as being oversold for the market and the really low readings to be overbought for the market. When I look at it, as far as I look at it as more sentiment oriented, and that's backwards for a lot of people, inverted, because sentiment is contrarian. All right, so as far as these short-term indicators are concerned right now, not much to say. Like I said, we're near that average. We're not seeing any climactic moves here. I mean, look at Friday. There was really not much to say as far as the net advanced declines in volume and price. And new highs, they are starting to trickle a little bit lower, which could be a problem, but the new lows are not increasing. So I think that gives us some information right there. It's not as weak as it may appear. Short-term indicators, we finally got a bottom on these. I like to see the bottoms when we actually have the ITBM, our intermediate term indicators, and ITVM looking like they're going to bottom. Those tend to be a bit better. For example, we got a bottom here on these indicators, and despite being very oversold, we were still showing the intermediate term indicators were still falling. So I'm a little bit nervous about this because you can see that they're still falling. But I look in the thumbnail, they are trying to bottom a bit. But when you get the similar bottoms on these indicators, that's when you usually see the best moves here. So we don't really have that confirmation for a move off of this breakout that I've put in here as far as a longer term rising trend channel. Still managing to stay above it, but short term, it still looks pretty good because the short term indicators are rising, but really want to see a difference in these intermediate term indicators. And when you look at it on their chart, not as good, right? The picture doesn't look so good. We've had this a major top on these indicators, and typically that precedes a decline, pullback, or in this case, consolidation sideways. So we'll be watching to see when these indicators bottom because, again, that tends to be pretty good for the market. And right now we're not quite seeing it. And even if these indicators turn up, I'm more interested, honestly, in the upside crossovers before I really feel like they've confirmed that bullishness in the intermediate term. But right now, intermediate term's looking a little bit shaky. Let's go ahead and look at the big four very quickly. So I'll start with UUP and the dollar. Been looking at this, and I even used it as my chart pattern example for the reverse head and shoulders. I think it does look very textbook. We did get the breakout that confirmed we do have that pattern, but it did come back. Did dip below the neckline, but we're starting to rise off of it. So I think you could still look at this as a reverse head and shoulders. I still think that we're going to get a bounce off of this, this bounce off support right here. But yes, there's some concern. We've got that PMO sell signal. The PMO is certainly showing that there's negative momentum going on here. And on balance volume, nothing's really supporting a continued bounce except really this chart pattern. And I think that the fact that we're still in an intermediate term trend model buy signal where the 20 is above the 50. So I'm going to watch this area and see if the support level holds. If we get another drop below this neckline, then in my opinion, the pattern is busted and we need to start looking at other things going on the chart. As far as gold is concerned, let's look at that very quickly. And really, we've just been consolidating. We've trended higher, and we're now starting to get a test at that 1,300 level. The PMO is set up very well. It's set up in a way that we could look for a breakout of that 1300 level. And you can see that the OBV, and I'm sorry, the scooter is doing well here. I'm looking at the sentiment. Right now, we are seeing some large discounts on the physical gold trust. If you want to learn more about premiums and discounts, you can just look up gold premium discount, and you should get some articles that Carl and I have written about premium discounts and using those closed ETF, those trusts that CEF is one of them, and then PHYS is the other. But we're seeing high discounts. That means that the gold market, people are still bearish here. They're still trying to, they're not, we're buying at discounts right now. I am still looking at this, with the PMO set up, it does look like we're going to get that breakout. But, I feel like the market is still looking pretty good through the end of the year. So I'm really not expecting it to do that much if we get that breakout above 1300. And in all honesty, I still think we're going to continue to consolidate between that 1270 and 1300 area. But my interest is now peaked. You can see even with the volume on GLD or gold in general, we're looking at here, still looking pretty good, and that PMO rising. So I know I hate to be so wishy-washy, but at this point, I'm going to trust the PMO and the scooter, and I'm going to say that we probably will get that breakout above 1300. I just don't think it's going to go that far. Look at USO. It's been very interesting, and I have marked all different kinds of levels of support and resistance. We've got that intermediate or that long-term trend model buy signal. The 50 has now moved above the 200-day EMA. Haven't seen that since earlier in the year when we lost that signal. Only was up there for a little bit of time. And this is the first time we've really seen some margin between the 50 and 200-day EMA, obviously due to this extraordinarily nice rally that we've had in oil. Bit concerned though here. I've got a PMO sell signal that's now moved in, and you could see on balance volume, a lot of disinterest, a lot of selling here, and we're hitting this overhead resistance now at about that 1130 area. This is an overbought PMO that's just going on a sell signal. It's really hard for me to get bullish right now on USO. Just looking at that with the OBV. Oh, we're almost out of time, and I did want Tom to have time to answer some questions. So I'm just going to move on. But at this point, I don't think we're going to see a move above that 1160 area. And looking at that PMO, I would look for a test at 11, at least 11, before we can get that rally there. TLT bonds, very quickly. We're right at that overhead resistance level, but we got the buy signal. It managed to stay intact despite the really large decline that we saw in gap down. But overhead resistance is here. We're going to have to see if it can make a move above it. You can see when we have, it's, for example, back here, we had that island reversal. So I'm going to be watching this very closely. And, honestly, if you look at this, if we do get that move all the way down here, I would say that looks like a pretty textbook head and shoulders with a left shoulder, right shoulder, and head here, coming in off of this upward trend. Remember, it's a reversal pattern, so we want to see it moving upward into it. So we'll have to watch if we get that decline. The PMO still looks pretty decent. Scooter is pretty decent. OBV is still rising. So I'm expecting a breakout above that to 127, but I just don't know if it's going to be able to hold on to that. When see positive momentum pick up a little bit here. That's all I have for the DecisionPoint report, and I know we're at 10:24. But Tom, I know you had some questions to talk about. While you get ready for that, I'm just going to really quickly show people where they can get to my PMO scan, because I get asked that every single week. So you just go in here to the Market Watchers Live blog, click on the latest article. This one's very long because I put all of my chart pattern examples in there. So if you haven't gone there and bookmarked this, you might want to do that. at the very end of all of our Market Watchers live recaps, you can see that my PMO scan is in there with other helpful links. So that's how you find it. And Tom, I know you had some good questions, so I'm going to let you just go to it.
All right, sounds good. Yeah, I was answering some questions in the room. So for those of you maybe who weren't following the chat, you might check some of that out. There were a number of questions that came up with respect to earnings beats and what John does at earnings beats. And to be honest, you'd have to ask him most of those questions or some of those questions. The only reason I know the answers to many of them is, or can assume what the answers are to many of them, is John and I worked together in creating earnings beats. And I left there and actually came to Stock Charts in March of 2015. So the earnings beat service was created, I believe, fourth quarter of 2013. So, and, you know, like every other service or every other strategy, I mean, it's been fine-tuned over the past few years, but the results this year certainly have been pretty, I would say, sparkling at the least. But anyhow, a couple of questions that had come in, I actually saw in some emails. And I don't go through my email all the time. There's just so many emails that come in. I just can't respond to everybody quickly enough. But a couple questions came in. One, does it matter if buying, because I like to buy on pullbacks after buying. And so the question was, does it matter if the buying results from new buyers or short sellers covering? I would say for me, it doesn't really matter. In fact, a lot of times stocks that are trending down and have been for quite some time tend to have a lot of short sellers because they, you know, continue to get bad news, and that's for the reason for the decline. And then all of a sudden the company comes out with a better than expected report and you get a breakaway gap. And sometimes those are great trades to make when a stock retreats on lighter volume, maybe to test gap support. So for me, it doesn't really matter. I don't, buying is buying to me and selling is selling. And I know that there are some who like to try and get in on a short squeeze where you get a breakout and you got a lot of short sellers. And that's a good strategy, but it's not one that I really focus on. Another question that came in is, how can I tell if or which stocks in an ETF are driving the action? And what I've done in the past, and I'm just going to pull up Yahoo, because I think if you go to finance.yahoo.com and you put in, hopefully I won't get one of these ads that start talking to us, but let me see if I can just pull up, for instance, the XLE, which is the energy ETF. If you go into Yahoo and put that in and you look under holdings for the various ETFs that you're interested in, and then go down and it give you the top holdings, and you can see Exxon and Chevron are going to have a tremendous impact on the XLE because between the two of them, they represent 40% of the ETF. But if you look at something, say, like the XRT, which I talked about earlier, which is very diversified, it's a retail ETF, and you look down below at the holdings there. I think I said there wasn't any that was above 2%. You can see. So there's not going to be much individual stock influence in the XRT. So I can't tell you specifically for each ETF. You just simply have to look it up and see if there are any major players or major holdings in that ETF. And if there are, then I think you'd be wise to look at the technicals on those stocks. Like with the XLE, I would not consider buying the XLE unless I was bullish on ExxonMobil and Chevron, because they represent such a huge percentage of that ETF. If they looked bearish, then I don't know why I would be wanting to get into XLE. Let's see, maybe one other question. There was a question about doing the yield curve, putting the yield curve on a chart. I would just say look at Arthur Hill's article in Chart Watchers over the weekend. There's no sense in me revisiting that. I think he did a great job there. And with that, I think we're about ready to run out of time. So how about we just simply go back here to stock charts. We'll take a real quick look. I'm going to continue, Aaron, watching the 10-year Treasury yield. I think if we get a breakout in that yield to the upside out of that triangle I talked about earlier, I think that would be bullish. Anything in particular you're watching?
Like I said, I'm kind of curious what's going to happen with gold, if it's going to be able to break that 1,300 level. So I'm going to be watching that. Actually, I'm pretty interested in what's going to happen with that.
Okay, awesome. Well, I want to thank everybody for joining us today. Just to let you know, we will not have Market Watchers live on Thursday and Friday of this week. Won't be around for the holidays, but we will be back on Monday. Mark Young from WallStreetSentiment.com will be joining Aaron on Wednesday. I will not be able to make it, but they should have a great show on sentiment, so make sure you tune in for that. And then finally, Chip Anderson is going to join us tomorrow for Everything Stock Charts. Definitely mark your calendar. Chip, I'm sure, will give us some great information and insights, not only into the additions that have been made recently at Stock Charts, but also give you a great idea of some of the things you can look to expect in the future. Again, thanks for joining us today. Complete the survey as you exit. We'd love to hear from you. As a reminder, Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everyone. We'll see you tomorrow. Happy trading.